Welcome, everybody, back to DeFi Raiders. I'm Relentless. I'll be the host of the show today. Thanks so much for joining us. We'll be talking to Joey here, the founder of a protocol called DYAD, a stablecoin project that he's working on that's collateralized with ETH that we're pretty excited to hear about this and the technology behind it. So thanks so much for joining us, Joey.
Yeah, thank you for having me.
Yeah, I was pretty pumped when I saw it, one, because the first thing I thought of when I saw it was, when MakerDAO had talked about starting to peg their token, to sell a bunch to use ETH as collateral, and some of the uproar that happened behind that. And so I was like, oh man, I'd like love to hear from a project that's actually doing this. And then I actually had seen before you had sent it to me. I listened to Hunting for Alpha on Spotify, and so I had heard it first, and then I saw it pop up, and I was like, oh man, I got to reach out and see if this guy wants to talk, because I'm extremely interested to hear about the tech and some other things that you're doing here, and I've seen some hype in different communities. So I'm glad you were open to joining us today. So
Yeah, absolutely. Super excited to talk about that. Just let me close the window there. Yeah, it's interesting that you start with Maker because this is kind of where the not the necessarily the design inspiration, but the motivation to build Dyad came from. Uh, Clearly, there was this demand for truly non-volatile but fully decentralized stable collateral. USDC obviously is controversial because it adds centralization, and I don't think you can be, or I know for a fact, a protocol can't be more decentralized than its most centralized component that it's built on. So if you're built on Circle, you inherit Circle's censorability and centralization, which is fine. I think there's always going to be a role for centralized stablecoins with fully custodied, fully regulatory compliant collateral. I think that'll always be a category. That seems like Circle pretty much has solved that, though. Ditto on the fully algo algo stable side, which algorithmic stablecoin is a pretty bad term because it's come to mean endogenously collateralized algorithmic stablecoin, which Dyad is uh, technically an algorithmic stablecoin. There's no governance mechanism. It runs completely based on data that it finds on chain. But it is fully collateralized with ETH, like over collateralized with ETH. So it's exogenously collateralized. But ditto, like I think that Beanstalk is doing some really interesting stuff in the fully algo stable space, like the fully endogenous space. I'm bearish on that as a category, period. I don't think it will ever take the place of exogenously collateralized stablecoins because there's just not that level of reliability at the end of the day. But I think that there are some really specific areas where those are really useful in DeFi. If you need basically a minimal carrying cost minimized stable asset that you can use for things that are maybe less mission critical than an exogenously collateralized stablecoin would be up to. But I think that, like, yeah, when I think of what is Dyad's first job to do in the wider world, it would be as a USDC replacement, basically, for protocols that at this stage don't have the ability to digest ETH in its raw form. ETH is too volatile in its raw form, so they can't just sell their USDC for ETH. Dyad essentially is a devolatilized version of ETH, basically. Like the core design ethos is that we suck out the volatility, but we add no level of censorability or centralization or governance risk or really anything. So we are basically taking the volatility out of ETH, issuing this stablecoin Dyad that is backed with ETH, but is completely isolated from its volatility, and really adding nothing else, allowing that to be this new super stable, but censorship resistant, fully decentralized, basically inheriting that level of censorship resistance and decentralization from ETH itself.
okay, yeah, cool. So a couple questions within that, right? So
Yeah.
for people, so one of the things that we try to do is make sure that we break this down for people who are, coming into the DeFi space, right? And, their understanding of a stable coin, right? The first, especially when I first joined, right, it was like, oh, okay, it's pegged to $1. It's always going to be pegged to $1. That's not true. But, or, there's risks there. But could you break down what exogenously collateralized means, right? So that they
Yeah, for
understand
sure.
what you're doing there.
Yeah, sorry for speed running that whole part. Yeah, so
No, go
basically,
for it. It leads into other questions.
yeah, for sure. So if you think of Terra, right? Terra is like the example of sort of like how bad stablecoins could go at this point. But Terra's whole thing is that they were fully endogenously collateralized. All that means is that the backing of the stablecoin, the thing that you basically can sell the stablecoin for and get back your like dollar denominated stuff, basically like why is it worth a dollar? Why does it hold peg? Their stuff you got back for that was another Terra protocol token called Luna, which basically that's like a pretty standard senior share type design, which has never worked in practice. It always, what happens is, so ideally, there's supposed to be this arbitrage secured peg where if the stablecoin starts to fall below 1 USD peg, you basically print the other token, the volatile token, Luna in this case, to basically buy it back to its $1 peg. Kind of like by me just saying that, you kind of intuit how that would go bad. If you just keep printing a thing, you get to this hyperinflationary standpoint that will just exacerbate whatever is causing it to lose peg in the first place. So you have this death spiral. That happened spectacularly. I shouldn't say spectacularly. It was really bad for a bunch of people I know and for people I don't know. But that's just an example of you print more and more and more Luna. Luna essentially becomes worthless, and you had like it's interesting to look at that chart from that day where you have these like degen spikes of people who are like YOLOing into Luna as it was being printed in huge quantities to try to stop this bleeding that the peg was experiencing. But the issue with this and the issue with endogenously collateralized stablecoins period is as faith is flowing out, forget liquidity, forget like the peg, as belief and faith in the protocol itself is flowing out with the liquidity and with the price. The stabilizing token, the basically the collateral, which is also a protocol native token, will immediately lose value. It doesn't even matter what the chart says. If people are losing faith in the protocol, which is very likely if it's losing peg in a dramatic way, if your only collateral for those tokens is something else associated with the protocol, people will be dumping that too. And if your mechanism for dealing with that price decrease is just to print more, it's just this death spiral, and that's where the term death spiral comes from. So USDC solves this by holding a bunch of like US Treasury assets, and they used to hold a bunch of other stuff, some of it more risky, but they switched just to Treasury assets because they didn't want to be classified as an investment fund. So they just hold these Treasury assets. Their whole business model is just earning yield on those and not passing it to holders of USDC. They're basically keeping the yield on the T notes and stuff because the service they're providing basically is making USDC available on chain and having this centralized, fully custodial collateral in an account somewhere in a centralized institution. So that's sort of a super simple way of solving it, but you inherit all of the centralization and censorship risk that comes with that. The holy grail, and this has not been cracked yet, and this is why we're designing DYAD in this space, is an exogenously collateralized, fully decentralized stablecoin. So exogenously collateralized just means that whatever backs the token is not, the value of that thing is not tied to belief in the stablecoin protocol. And that's not the orthodox way of describing it, but that's ultimately what it is and what it's about. Where if people are basically getting super bearish on your protocol, the thing that they are doing the bank run on is something not associated with your protocol, something like ETH or something that is very established, hopefully with a low level of centralization. Like using USDC for that, for example, would be pointless. It would be like putting a V4 budget engine into a Ferrari chassis. You'd be building your super decentralized governance tree thing on the most centralized stablecoin. So it would inherit that centralization. But the trick of it is building it on something that it has a tremendous amount of momentum and faith and TVL, so ETH in this case. The problem with those is that they're very volatile. Like ETH and Bitcoin are the only two that I'd really put in that bucket, and they're both volatile, which is why this isn't done. That's why USDC is so popular as collateral. It just makes it trickier to work with, that super volatile collateral. But that's basically what DYAD is designed to do. If you want to break it down to like a metaphor, you can think of ETH as like a bumpy road. DYAD, the protocol, is like the damping system, and then the stablecoin itself, DYAD, the token that people hold because they want a stable store of value or collateral or whatever, is like the car cabin. So as ETH is very volatile, DYAD, the protocol, just absorbs that volatility and isolates the cabin from it. What's cool about DYAD and sort of how it grows and how it starts to dominate in the stablecoin space is it's like a regenerative damping system, like you'd find on a Tesla or a different EV, where the bumpier the road, the more energy for the battery that damping system will actually generate. Obviously, it's not a perpetual motion machine in the example of the car. You can't generate more power than you're losing through those bumps. But with DeFi, it actually works really well. The more volatile ETH is, the more in profit the DNFT or the NFT denominated volatile positions will be. The positions that basically compete with each other to gain maximal access to the protocol's upside.
Okay. All right. A lot to unpack there, but I get what you're saying. Okay. So taking into account the volatility, right? So in layman's terms, right, how do you explain that it takes out the volatility, right? So does it, right, it's redeemable $1 to $1, right, with ETH. But does that, if you buy in, right, you buy in for a certain amount of DYAD at this cost of ETH and the cost of ETH goes down, how does it have like an interest accrual right there, or
Yeah,
how does
yeah,
it actually take out volatility?
you're getting to the core design of the protocol. So I mentioned these DNFTs before. Unlike a protocol like Terra or like other stablecoin designs where there's like the stable token and then the volatile slash governance token, we don't have that. We only have DYAD, the stable token, is our ERC20. In the place of one of those volatile tokens, we have these NFTs. We call them DNFTs. That just means DYAD NFT. And each of these NFTs there are going to be like a couple thousand of these to give you a sense of the scale. We have a mechanism at launch where the market basically determines what the total number will be. But once that mechanism runs its course, there will never be more of them. These are totally non-inflationary. The number is the number. So we can assume like between 1 and 3,000 of these NFTs. But basically, each of these NFTs, in order to mint DYAD from the contract by depositing your ETH and getting out 1 USD's worth of DYAD, depending on what the Oracle price of ETH/USD says at that point, you need to hold one of these NFTs. So it's not permissionless minting. You would need to be the wallet that mints, that executes the mint function in our contract, needs to be holding one of these few thousand NFTs. When you mint as one of these NFT holders, the NFTs have as on-chain metadata. So the same kind of metadata that like Bored Apes would use to show their different traits, like laser eyes, whatever, cheetah, fur. Those are stored as on-chain metadata. That's part of the ERC 721 standard, which just defines how those NFTs are structured. So our NFTs on-chain metadata is comprised of 3 things. There's total DYAD minted, DYAD deposited, and XP. And I'll get into each of those and sort of what they mean and how they make the whole protocol work. But basically, whenever you mint DYAD by depositing your ETH to the collateral vault, you get 1 DYAD, depending on the ETH/USD price, for each dollar's worth of ETH you deposited. It increments your DYAD minted field on your on-chain balance sheet. So again, this is part of the DNFT's like traits essentially, but they're dynamic because the more you mint, the more that trait is incremented. And then as a DNFT holder, you have the option of leaving the DYAD. So when you mint DYAD as a DNFT, it lands in this buffer vault or this damping vault that we call it. So the protocol basically has these 2 vaults. There's the ETH collateral vault, which I've kept talking about. That comprises the protocol's TVL. So the whole value locked of the protocol is represented by the ETH in that vault. Then you have the DYAD damping vault, which is another vault controlled by the protocol that holds DYAD, so the stablecoin that DNFTs have just minted. So when they mint, it's incremented on their balance sheets, but it goes into this DYAD damping vault. And when DYAD is in this damping vault, the protocol can directly burn it when the price of ETH goes down, or mint new tokens to it, new DYAD tokens when the price of ETH goes up. And that is essentially how the supply of DYAD expands and contracts in order to be equal to the value of the ETH that's in the collateral vault at any given moment. So let's say ETH goes up 20%. The protocol will mint new DYAD tokens to increase the amount of DYAD in the damping vault, basically the DNFTs have minted there, by 20%. Now, DNFTs have the option of withdrawing DYAD from that damping vault. So when they withdraw it, then the DYAD actually appears as like a stablecoin token in their wallets, and they can do whatever they want with it. They can sell it to the market, they can use it as collateral, they can just keep it as a store of value, really whatever they want to do. But that changes the DYAD deposited field in their on-chain balance sheets, basically. So now the DYAD minted is going to be higher than their DYAD deposited because they withdrew some of their DYAD from the damping vault. When the DYAD is withdrawn, it is not able to be burned or increased by the protocol. So the protocol needs to use, if you want to think of it as really like the shock absorber to absorb changes in ETH price, is the damping vault. The portion of DYAD that's in the damping vault versus DYAD that's circulating allows the protocol to basically absorb changes in ETH's price, which is always happening. ETH is quite volatile. So the protocol directly controls the number of DYAD tokens in that damping vault, but tokens that are circulating cannot be controlled that way, and they always need to be redeemable for $1 worth of ETH from the damping vault, or not from the damping, but from the collateral vault, regardless of what ETH's price is at that point. So that means you can sort of, if you want to think of it as like a comparison to Maker, you can think of all the DYAD in the damping vault as our over collateralization, and the DYAD that is circulating is sort of what is protected by that over collateralization we have in the damping vault. Does that make sense? I can go back into detail on any part of that. I know I'm dumping a lot each time that I explain something.
Yeah, no, I mean, it does make sense. I mean, it's obviously, somewhat complex, right? This is honestly a pretty innovative approach to take out that volatility. I'm gonna have to go back and listen to a few parts of it for sure.
A good way, if anyone's familiar with Ampleforth, so Ampleforth is one of the earliest stablecoin designs. They basically, it was super simple to the point of not being that useful, but it's sort of an interesting early experiment. Basically, they trade price volatility for their stablecoin for supply volatility. So if you're holding this Ampleforth stablecoin and the price of ETH goes up, you will find in your wallet more of these Ampleforth stablecoins. If the price of ETH goes down, you will find fewer of these Ampleforth stablecoins. So that's the only way they don't absorb volatility. It's just you're experiencing it as supply volatility versus price volatility, which you can guess is sort of pointless, but it's sort of how we treat DYAD when it's in the damping vault in the protocol. When it's not in the damping vault in the protocol, it functions as a real stablecoin. And that's ultimately the goal of DYAD. We want to have the most performative decentralized stablecoin. And what performative means basically is super deep depth of over collateralization, because that's what the demand side wants from a decentralized stablecoin. It wants to know that there's like many times the amount of ETH basically ready to back this $1 denominated stablecoin that you're holding, that if the price of ETH goes down, you will always be able to redeem this for $1 at the new price. There won't be like a depegging event. So that's super important for it to grow and have demand on the demand side. On the supply side, you want the lowest possible carrying cost. So you want to be able to create a stablecoin that you really, for the amount of collateral you put in, you get close to that amount back in terms of your stablecoin. So Maker sort of has this medium approach where they enforce 150% over collateralization. So you need to deposit 150%, like 1.5 times the one USD that you're getting as DAI to collateralize that DAI. In the case of DYAD, you get exactly the amount of DYAD back of ETH that you deposit, and you can withdraw all of that whenever you want to. It's just that the incentive to do that only starts to appear once there's market demand for DYAD, and only really makes sense for the very top DNFTs on the XP leaderboard. And this gets us into the discussion of XP, which is where this gets super gamified and where it gets interesting and where it really starts to separate from other stablecoin designs and just other DeFi protocols, period. So before we get to that, I want to clear up anything that was confusing about the structure I just laid out.
Nothing really confusing. I guess I'll just ask real quick. So like we talk about like a macroeconomic condition, right? So if people, come in, they mint their DNFTs, right? There's only so many of those that can be held, but what I'm gathering is the amount of DNFTs that can be held is not related to the amount of DYAD that can be minted over time, though, obviously, if it's going to be a full-scale stablecoin, correct? There's just
you can as much ETH as you want to deposit, you can mint as much DYAD as you want.
Okay. All right. So then with that always being redeemable $1 to $1, what happens if ETH collapses? Right? What if regulations come down and it becomes a security and not a commodity and people want out, just the worst case scenario, what happens if ETH collapses to zero?
Well, sure. So there's two conditions, and I accept these from the challenge because literally the two conditions where dyad fails and we can't build it not to fail in these conditions is if ETH goes to zero, and not just ETH goes to zero because we could recover from ETH going to zero and there'd be a reason to use dyad. ETH going to zero and it really being dead, nobody wanted to get back in. Like there's no possibility of it coming back, then yeah, of course, DYAD is dead. DeFi is basically dead unless there's some other chain that does it in a totally different way that doesn't fall under the same regulations or whatever. If that happens to ETH, then yeah, DYAD fails, but this all fails, and we all have to go back to whatever we were doing before.
Yeah, that's accurate.
Ditto.
That's accurate.
The other way that it fails is if ETH gets so successful and so popular at some point that it stops being volatile. It just starts acting like a stablecoin itself. I don't see that happening on any reasonable time frame. I don't see any inflection point that would cause that clearly. ETH could get much, much, much bigger, and I don't think that'll have a damping effect on the volatility at all. So that would be the only other condition. Basically, as long as ETH is volatile, and it can be volatile at any price point, DYAD is a compelling thing to work with, and will have value.
Yeah, because if it loses volatility, then there's literally no incentive to hold DYAD over just holding ETH. Yeah. So
exactly, and there's no
okay.
need. I mean, if ETH loses volatility, but it's not at zero, then we have sort of a perfect stable coin, and we can all stop working on this problem. But as long as ETH is volatile, you need a layer like DYAD in order to make it usable by a majority of other DeFi protocols.
Yeah, and we don't have to worry. The U.S. government is going to give us the central bank digital currency, and that'll be our perfect stable coin. So
yeah, I could
hopefully not.
get into sort of the macro situation and why I think it's mostly, it's going in a direction that I don't like that bill basically making stablecoins like Terra and dollars collateralized stablecoins essentially illegal after 2 years. Obviously, I'm vehemently opposed to that. I don't think that is a reasonable use of the government's oversight, or it's just crushing innovation without really understanding what they're regulating. Were that to pass, or really any incoming regulatory risk, ultimately that is a tailwind for DYAD, and I really don't like that it is, because that is not positive development in any way. But because DYAD is governance free, fully immutable, backed only by ETH, not composed on anything other than a basket of oracles that we have pretty substantial fallbacks from, it really is less exposed to regulatory risk than pretty much any other major stablecoin right now. So that's not good. I don't think regulatory capture should be a business strategy, but it's something that we've built very consciously around.
Yeah, I mean, it's good that you're thinking about that. So within that, how does governance free explain governance free for anyone who might not have like a thorough understanding of what
Yeah,
governance within this space
for
is?
sure, for sure. So the classic governance design is like Maker, where you just have these tokens that let you vote on changes. Most other major protocols, Frax, Beanstalk, even Aave, like Curve, all of these have governance mechanisms where you basically, if you hold a certain portion of these governance tokens, you can propose and vote on changes to really like fundamental stuff. Um, I think that governance is interesting and it's great in certain protocols doing certain jobs, like with certain like attack surfaces and security risks and TVL that they're holding. I think that for a piece of base layer DeFi infrastructure, which DYAD is absolutely designed to be, it is not securable enough to remove it as a significant risk. I don't think there's any governance mechanism that can't be exploited by sufficiently motivated actors. So for the same reason, like we're designing the expansion mechanism for DYAD to L2s and alt L1s to not use any bridges, because I think bridges just as a category are fundamentally insecure. I feel the same way about all existing forms of governance. They just present an attack surface that is reasonable for certain other protocols, and that's fine. But for something that is creating a super solid reserve currency that people are going to be relying on, it's just too great of a security risk. So let me break down though. So governance really has two jobs to do. And the reason I think existing governance designs aren't good is because they try to use the same mechanism to do both of those jobs. And those jobs are pretty different. So the job number one is allowing the protocol or the DAO or whatever it is to respond and react to changes in the external environment. And the external environment is always changing. So you need a mechanism to allow a system to change based on changes in the environment. So governance usually does that job. Job number two is giving the members of the community or holders or users of the protocol a feeling of agency and involvement, ownership of it. That's also, it seems like that's less of a thing, but I think that is the motivation for governance and the way governance is designed in a lot of cases. It certainly drifts that way. But like I said, both of those jobs, which are governance's main two jobs, are usually not done well by the same thing. So to allow the protocol to adapt to changes in the environment, that's really the motivation for the whole DNFT system and the fact that DNFTs alone can mint and supply the market with DYAD. What we basically create are a few thousand MakerDAOs that are competing to supply the market with the same token. So there's this competitive pressure to essentially out optimize each other, out compete each other. And what we get is this self-optimizing stablecoin that is still immutable at the core contract level. There's no mechanism by which anybody can adjust our code, which just leads to a level of security that any human access to the core contracts would decrease. And then job number two, the community aspect. We have a great community right now. We're sort of in a more centralized stage because we haven't deployed to main yet. But if any of you, I think some of you, like half, are already on our Discord, but if any of you want to join, you can get a sense. It is a really good community, and community is super important to us. But we want communities and guilds and clans and different groups to start forming around DNFT ownership rather than any sense that you can have an impact on the core contract itself. The core DYAD contracts are going to be this ownerless public good that really is best thought of as like a playing field or like an arena or like a map in a real-time strategy game. That's not where the center of the community really should be. I mean, it can gather. We're going to keep our Discord, obviously, but we want the real sense of community and sense of ownership to be around these groups of DNFT holders and protocols they build and users of those protocols to really get this sense of competition. Like if you think of MMORPGs like the World of Warcraft that we mentioned earlier, your social unit in that game is not all the players of the game. You're not saying that you're part of the WoW community necessarily. You probably think of yourself as part of a guild or a group in that game. And that's really what we want to happen with DYAD. We think that that will lead to higher competition between these groups. It'll lead to more incentive to outcompete others, and it'll just draw more people in because there's this faction thing going on, which will take on a life of its own and essentially fill that role of community ownership and membership. And they could have more centralized governance mechanisms within their groups. That's fine. The DNFTs are designed to be experimented with in a competitive frame, but experimented with, and if they blow up or if something goes wrong, that contagion cannot travel back upstream to the core protocol, and that's very clearly designed.
Okay, so real quick before I move to what if that happens to one of them, right? What happens to that DNFT and the assets that were held within it?
Yeah, for sure. So what happens, our way of basically dealing with liquidations, which we don't liquidate, what happens is if a DNFT basically is overly degenerate with its position and it has downside exposure, it's on the XP leaderboard to the degree that its downside exposure means that its burn liability from the price going down of ETH erases all of the DYAD that it has deposited, then it will continue to basically accrue debt on its balance sheet where the DYAD minted goes into the negative. that means that it cannot gain any more XP, it can't gain any more DYAD, it just needs to be cleared in order to be active in the protocol again by the holder, or the holder can bring it on secondary and allow the market to price it with the debt. And then somebody could get it for a discount pretty much. They would then need to clear the debt before they're able to use it. But that's essentially how our liquidation mechanism works. The holder who is subject to the liquidation, they're not actually liquidated, they're just strongly incentivized to sell it. As a safety, this is almost certainly an edge case, but if an individual DNFT's debt exceeds 0.001 TVL of the entire protocol, that DNFT will just be burned and the total supply will decrease permanently by that one. So that's a way of, it is a socialized loss because that debt's not getting paid and the NFT was burned. But by decreasing the total supply, everybody who holds a DNFT, they now hold a slightly more scarce and thus more valuable NFT because there will never be more, and the supply just decreased by one. So that's a way of, it's both socialized loss but also immediately mitigated by the decrease in supply of the total number of NFTs.
Okay, so this is where some of the gamification that you were talking. So this has to be, so if someone mints an NFT, they have to be like active in the control of this NFT.
Yeah, so the
And this is
core of
where
the
gamification comes in.
Yeah, the core of the gamification is XP, which literally just means experience points. And that is the third trait on the balance sheet, on each DNFT's balance sheet. You gain XP when the protocol burns your DYAD tokens that you've basically deposited in the damping vault. So when the price of ETH goes down and you as a DNFT holder are subject to some burning of the tokens you deposited, you gain XP for every token that's burned by the protocol. So XP is not, you can't like cash it in. It doesn't indicate any token supply underneath. It is literally just an on-chain metadata trait that's incremented every time your DYAD tokens are burned. So what is the point of XP? It's just this inflationary point system. What it does is when the price of ETH goes up and the protocol's minting new DYAD tokens to expand the supply, and those are going into the damping vault, your portion of total XP, so basically where you fall among the other NFTs on this XP leaderboard, determines how much of those new tokens are routed towards your balance sheet. So you're basically competing by putting your liquidity at risk for the protocol to burn, by basically bleeding for the protocol. You move up past others on this leaderboard, and the higher up you are on the leaderboard, the greater your allocation of newly minted tokens when the price of ETH goes up. Ditto, the higher you are on the leaderboard, the lower your liability when the price of ETH goes down and burn liability is being assessed. So this is the core of the gamification. This is the core of the competition. You're basically competitively deploying your liquidity, your DYAD, which again is redeemable for 1 USD of ETH. So it's like you're deploying a real thing for the protocol to provide the protocol buffer, basically over collateralization, to burn when the price of ETH is down. When that happens, when your DYAD is burned, your DNFT gains XP. And the greater portion of XP you have relative to the other DNFTs, the higher you are on this stack ranked leaderboard. And then the higher you are on the leaderboard, the greater your allocation of newly minted DYAD, and the lower your burn liability of DYAD that needs to get burned because the price of ETH has gone down. So it's this zero sum. XP is basically this hyperinflationary incentive that it just creates this zero sum rerouting of upside and downside exposure to the price movements of ETH via this minting and burning mechanism in the damping vault. So if you're at the top of this leaderboard, a good way to think about it is if you're at the top, like the top 20% or so, you're basically sucking the upside exposure from the bottom 80% off of those DNFTs, and you're getting that upside, and you're simultaneously dumping your downside exposure to ETH onto them. So at the top, you could have an equivalent position on ETH that's like 5x upside exposure and like 0.3x downside exposure. So kind of this magical ratchet-like position where regardless of the direction ETH is moving, as long as it's volatile, as long as there are these minting and burning cycles happening, you are in profit because you're leveraged to upside and you're basically under leveraged to downside. So like a ratchet, a mechanical ratchet that takes random or Brownian motion and converts it into useful energy that moves in one direction and can drive a motor or whatever, your position on ETH, your asymmetric upside and downside exposure, means that no matter which way it's going, as long as it is moving and it's volatile, you're gaining DYAD. You're up in terms of DYAD. Now, the question then obviously is why would these lower 80% of NFTs on the leaderboard stay in those positions? Because as you could guess, in order to create those great positions at the top, the positions towards the bottom, like the bottom 80% basically, have less than 1x upside exposure to ETH and greater than 1x downside exposure. So it kind of moves in the opposite direction. No matter which direction ETH is going, as long as there's volatility, your dyad's being burned in aggregate. Why would you stay in that position? The reason is the XP accrual efficiency per dyad token burned is much, much, much greater at the bottom than it is at the top. So for every dyad burned, if your DNFT is at the bottom of the XP leaderboard, you're giving up a lot of your upside exposure to ETH. You're taking on a lot of downside exposure via this minting and burning of the dyad tokens you have deposited. But for every dyad token that's burned by the protocol, you could be gaining like 4 XP to your NFT. Whereas that top position that's taking your upside exposure and giving you their downside exposure, so they're just profiting in terms of dyad, their XP accrual per dyad burn is like 0.001. So that radically different accrual efficiency is really the foundation of how this incentive structure remains sustainable. Because you're going to get people at the bottom just working to accrue XP as efficiently as possible. And then with the secondary market for DNFTs, the secondary market prices the entire balance sheet. So you could really buy a floor DNFT with the least amount of XP, put some dyad into it, allow the protocol to burn that dyad, gain XP and move up the leaderboard at the most efficient spot possible at the bottom, and then go back on secondary and sell that higher leaderboard position DNFT for a profit. And the protocol is specifically designed to ensure that that trade is always profitable, that it always costs less in terms of burn dyad to get your DNFT to a position on the leaderboard that then you could sell for a profit versus what it took to get there.
Interesting. That's super cool. So in essence, the XP is like kind of like a credit score, right? Then
It's like
for
so kind of how credit functions where the better your credit, the more you're going to be like getting people trying to loan you money because you're less of a risk. It's actually if anyone's familiar with like basic EE, it's like voltage and amplitude. Or sorry, voltage and amperage, not amplitude. Sorry. Um, Amperage meaning sort of the width of the pipe that's delivering you your dyad. Voltage meaning like the pressure in that pipe. You could code XP or really not XP, but your rank on the XP leaderboard is amperage. Like how wide is that pipe that's allocating you dyad or XP? And your percent ownership of the damping vault, which is sort of the first thing that determines your allocation or burn liability. It's just a pro rata determination. That would be like voltage. That would be like how much pressure of change is traveling down that pipe. So that's probably the best metaphor for XP versus percentage ownership of the damping vault or of the total minted dyad. But yeah, ultimately this is designed to do two things. It incentivizes competitive allocation of liquidity to basically maintain the peg, especially at times of high volatility for ETH. So really when, the peg could be in greatest danger, the incentive to allocate liquidity to defend it is the highest because that's when you're earning XP or that's when you're earning dyad at the top. It also incentivizes every DNFT holder, whether they're an individual, a DAO, a protocol composing around it, whatever, to optimally run their balance sheet and to adhere to some form of fiduciary duty because the protocol allows you to be totally degen with it. And at the top, when your downside is really shifted onto the lower positions, you can be really degen. You don't need to collateralize your positions as much because your downside is so minimized. So your burn liability is minimized and you can just supply the market with dyad really aggressively. The market prices both where you are on the leaderboard, how much dyad you have deposited, and how much you have withdrawn, which is basically your individual collateralization ratio. And it will punish you if you've run your balance sheet poorly. You'll get a lower price for it. And that's ultimately what incentivizes everybody to try to optimize their position and their monetary policy, basically, that they're running on their DNFT.
Okay, so what happens then if someone mints the DNFT and then forgets about it?
Yeah, that's a great question. So we talk about like the person who mints a bunch and they're on a ledger and they like lose the ledger or they get hit by a bus or whatever. It's just they're on a ledger somewhere not doing anything. So two things. Number one, the protocol sets a dynamic floor for like how much DYAD you have to have deposited through your DNFT on your balance sheet in order for it to even be active. So a DNFT will not be active in the minting and burning, and the basically the protocol will be blind to it unless it has this minimum. That minimum is starting at 5,000, but it will be dynamically adjusted based on sort of on-chain data that we're seeing of how people are using it, how they're reacting to changes in ETH price, how they're basically pricing ETH implied volatility. But yeah, that's number one. So if you never put any DYAD into it or you withdraw all of it right away, it'll just not be active. You'll just be holding it. If it's not active and if it's basically not gaining XP and everyone else is racing ahead gaining XP, there will still be a value to it. You could buy and hold and not do anything. That value will strictly be based on the scarcity as the protocol grows in TVL and also who the players are who are coming in and the amounts that they're able to make running this optimally. You'll be getting bids less from other degens and more from other protocols or HFT shops that are getting into DeFi or funds, places like that will start to be attracted to something like this. Some already are, but that's more in like the seed investor bucket. This is more just opportunistic, really sharp traders coming in. They will be bidding and protocols will be bidding as the value of the DNFT, of just having a DNFT, having the ability to run your own balance sheet and mint DYAD directly. That will drive the floor price up, and you'll just own the floor DNFTs at that point, which is fine. You'll still be accruing value that way, just based on scarcity. Um, a really good way, if you don't lose your ledger and you don't get hit by a bus, but you just want to passively accrue value to your DNFT position and be maximally exposed and leave as little money on the table as possible while still being passive. We're developing a composing protocol. We're just calling it the decoupling protocol right now, which basically decouples the three roles of the DYAD core contract. Those three roles are DNFT owner, player, or DNFT manager, we could call it, and liquidity provider. So normally, if you just interact with the core contracts directly, you need to be all three of these. You need to own the DNFT, you need to supply liquidity to mint DYAD, and you need to play the game. You need to make decisions and run the position. This protocol would allow DNFT holders to rent their DNFTs to people who want to just play and don't want to own a DNFT or can't own a DNFT, but they think they're good at this or have some kind of edge, so they want to play. And then liquidity providers can just contribute to a pool which is staked on the players based on their performance, sort of like a GMX style leaderboard of like how good their P&L is over like a day, a week, a month, whatever. The protocol will automatically allocate these players DNFTs and liquidity to play against each other. And remember, they're playing the same game against people who just own their DNFTs. So this protocol that decouples these positions, you can sort of imagine what it would do. It would attract, there are already alpha groups like forming teams literally to join this as players. It will attract sort of the most competitive people in the space as soon as it becomes clear the type of skills that this yields to, the level of competition, and really like what the upside potential is of being a player, which in turn will become a very viable place for DNFT owners, many of whom are seed investors who just want a passive place to park their DNFTs. They park them in this protocol. They're allocated to the players based on their performance in the game. And then you have this liquidity pool that will allow anybody from someone who has like a fraction of an ETH and wants to just YOLO it in to see what happens to Alchemix or Pickle Finance who need like these sources of generalized yield that are not overfished like liquidity mining. So having this ability to basically deposit liquidity into this protocol, that liquidity is staked on players based on their performance. You get this virtuous cycle where the aperture of both liquidity inflow into DYAD, but also of who can participate from day one is just greatly expanded to basically the benefit of everybody.
Okay, so projects are able to come and invest their money based off like the highest performing, kind of the highest performing player.
Exactly. And this would be a portion. So the ultimate vision is like we as the dyad team are building this protocol, but we want other teams to try to build other competing protocols or find some other edge of like to kind of compete for DNFT holders who want passive yield on their DNFTs to basically lock their DNFTs in these other protocols. So I know another team that is not our team is applying like machine learning to looking at on-chain data from dyad and developing automated strategies based on that. So if they provide greater upside for DNFT owners than we do with our little composing protocol, having them lend them out to human players, then they will outcompete us and they'll get more DNFTs. And then we need to up our game, or maybe another team comes in and tries to do that. But because the core contracts are immutable, because they're so highly composable, the DNFTs themselves are highly composable, our goal is to create the maximum opportunity to extract and create value from these core contracts for us and for many other teams. It's more important that it's a competitive space where it's really easy but also very competitive to develop new protocols, new features, new things for this community of DNFT holders, and also those who just have a stake in this, even if they don't own a DNFT directly. And that's ultimately what the vision of DYAD is.
Yeah, man, this is, I read through the I read through the medium and all that, and I was trying to like figure out a lot of how this was going to work. And this is so much I guess crazier than I thought in a way, especially with the gamification and how other
Yeah,
people are able to come in and invest on people's individual skills. Um,
totally,
that
totally,
it
totally.
really,
And again,
yeah,
there's this weird blind spot where it's like the more consumer facing something is, the more appropriate people think gamification is. The more like infrastructural something is, the less appropriate people think gamification is, which is just so wrong. I think that like infrastructure is so under gamified right now. You're gonna have the same basic like game theory mechanics that you have with consumers competing against each other that you will like giant protocols or funds competing against each other. And like you see this in TradFi everywhere. Like if you get into the microstructure of markets and you have these market makers and then these HFTs trying to provide sharp liquidity to them and basically make them take bad trades because they have an information advantage, and then how market makers work to defend against this and separate sharp flow from soft flow. It's just like that highly competitive. It's not even gamified. It's just like a game that's almost like a factor of nature because the market's gotten so granular at that level. That's what allows the higher level, more abstracted, more quote unquote normal financial stuff to happen. There's this hyper competitive game that's occurring where you have these super incentive. This is where you get the shops that like drill holes through mountains to get direct line of sight information from some trading venue so they can be like a couple microseconds ahead of somebody else. That's where you get these investments in these teams and this level of competition that is just outside of anything else in the private sector. In terms of so focused on one specific hyper gamified space. And that's ultimately how we want the direction we want this to go in. We want to start attracting the most aggressive, smart, and capable players to try to find an advantage here.
yeah, uh, yeah, and you're first in this concept too. I think that's people always want to be first and be the best at being first too. So, one thing I want to ask that you kind of touched on is your infrastructure. Have you built these NFTs on any existing infrastructure, modeled them after anything, or what have you kind of looked at as kind of your inspiration for how you wanted to build this?
Yeah, I mean these are, as new and fundamentally different as our like economic design and incentive design is. Our engineering team, shout out to Sharif, he's just so talented at this, but their approach, because this is immutable and because that immutability is a major forcing function on simplicity and reliability, because we'd have to do a hard fork if we fuck something up and deploy to mainnet. We really try to use existing standards and primitives as much as possible. So like the DNFTs, we add as little and change as little from the ERC 721 standard as possible. So those are highly compatible anywhere an ERC 721 NFT is. You could use this. So if you wanted to, you could trade them on OpenSea. OpenSea is probably going to ban them, which is cool. But until they do, you could trade them on OpenSea if you wanted to. You could trade them on SudoSwap. Anywhere you can use ERC 721s. We're actually working with the engineering director of Art Blocks, a dude named Aaron, who's also an excellent generative artist himself, to create generative PFP representations of each DNFT. So this will be another composing protocol. You load your DNFT into this protocol, and it looks at its on-chain metadata, basically its balance sheet, and it can create this program, this kind of procedurally generated image that you could use as a PFP that could be sort of the visual representation of your DNFT. In a permissionless way. Like that won't touch the core contract. It'll just read what the core contract is putting on chain and create this visual around it with its own logic. So yeah, I think that like we are building to standards, but we are very, very picky about what we compose over. So even though we're using the ERC 721 standard, we're not composing over like Manifold or something that spits out ERC 721s. Our own contract is creating that and putting that on chain. The only thing we compose over is literally ETH itself, and then our oracle function, which oracles are this. It's like this band-aid, like duct tape problem to the fact that blockchains are deterministic, and you need to get non-deterministic information onto them. So oracles are the solution, but they're super imperfect. Even for us, we're obsessive about our security. The oracle function is probably the biggest attack surface that we have, which is fine because there's so much work that goes into that we're just standing on the shoulders of. Like we're forking a lot from Liquidity, how they handle oracles, the fallbacks, the security. But yeah, that's basically it. We're built over Teller, Chainlink, and fallbacks from there, and then just ETH itself.
Yeah, that's kind of a perfect segue because I was going to ask about your security and like what approach have you guys taken to like stress test this model to approach those different attack vectors? Because I can imagine that with this being thousands of different DNFTs and different people, operating all those DNFTs and like I imagine that's incredibly complex.
Yeah, I mean it's one of the benefits. So the fact that XP, which is the primary inflationary incentive here, is not a fungible token. It's not an ERC20. You can't pull your XP out of your DNFT and sell it directly to somebody or dump it, which allows it to be hyperinflationary without harming the economic sustainability of the protocol. You can imagine if you accrued it as an ERC20, the chart for XP would just look like a typical farm token. It would just constant sell pressure. So because in order to cash in your XP on the secondary, you have to sell your entire DNFT, it prevents it from having that sort of negative price action. But yeah, the fact that we're dealing with on-chain metadata versus token transfers gives us some more breathing room in terms of security. But in terms of our approach, so we have audits scheduled. We're running our testnet right now. We haven't started officially with the incentives because they're still changing things so much, but you can go to our front end on Gorley, mint DYAD, mint DNFTs, play with it. You're definitely encouraged to do that. We're basically trying to, so on the smart contract side, it's more straightforward. Like we're not using anything exotic. All the functions we're using are thoroughly battle tested, and then we have the audit process and the bug bounty process, which is just more standardized. So the smart contract risk is actually not as much of a risk as just the economic risk, because that's the really new stuff that we're doing. So by economic risk, I just mean like somebody finding an edge within the rules of the protocol that we do not see right now. And that's like a big thing in DeFi, period. Like you have this dude, Avi, I'm sure you've been following it, who basically did the mango hack. And whether it's a hack, or I love how people are calling it the highly profitable trade, that's kind of a good litmus test on sort of where you fall on this like code is law spectrum. I'm not going to wade into that one. I think you could probably guess how I feel about it, but I think that, so a dude like Avi coming by, like how do we get him to try to break the protocol before we deploy to main is basically the goal here. So we're literally offering. So there's a general bounty of one DNFT, not even the allow list, but you literally get airdropped a DNFT for free if you can propose a way or a macroeconomic condition other than ETH goes to zero or ETH becomes stable. Literally any other, or like nuclear war, whatever. Anything that could happen without all of ETH also breaking, or a strategy that you could execute within the laws of the protocols we describe on this AMA or in the manifesto where we lay that out. If you can come up with something, either strategy or macro condition, that would break the protocol, basically forcing us to change an existing rule or add a new rule, you get a free DNFT. So we definitely want to incentivize that. That's ongoing. Nobody's done it yet. But at the same time, like I'm making connections to dudes like Avi, the super hackers, basically, who the ones who you can even contact. But that's who I'm getting to. Yeah, we have like an audit scheduled with Trail of Bits, which is just kind of standard. But other than that, the other people who are going to be essentially running an audit process on our smart contracts are these black hat to gray hat like protocol exploiters, not people who've done like sort of the basic like flash loan governance attack shit, which is just kind of boring at this point, but those who either are attacking on like on an MEV level, like hunting the mempool for opportunities to sandwich or front run transactions that could happen here. And this is specifically important with how we update the DNFT's metadata on chain, the sequencing for that. That could be like an MEV oriented attack surface. So we're spending time on that. And then the other thing, just playing it really aggressively, is there some strategy where you could take out a loan on something and pump up a DNFT and then drain it, or just things like that. We're trying to get sort of the smartest people there to try to break this protocol in return for essentially like advisor like allocation of DNFTs. So that is super, super valuable to us. We're really trying to get anyone who would break it to break it before we deploy to main. But obviously we can't get everybody, and if we get to like 1 billion TVL, clearly that will incentivize a category of person or team or state actor who is not going to be incentivized by some allow list testnet free DNFT stuff. So that spread of like the higher our TVL gets, the more challenging adversaries we'll attract. That leads us to anything we think could be an attack surface. We don't know how it would be attacked, but it could possibly be an attack surface. We just create a market mechanism for putting a cost on executing it or abusing it. So, for example, I talked about this DNFT updating sequence thing. The way that our protocol works, the DNFT metadata is not kept updated real time on chain until DNFT holders do an on chain action, whether it's minting DYAD, withdrawing DYAD, whatever that is. We keep the state of the two pools and the ETHUSD price updated in real time on chain. And anytime a DNFT needs to do something, we can derive that DNFT's current state and adjust their previous on-chain state to that current state. Now, this could possibly be an exploit lever if there's some way somebody calculates that if I update right now when this thing is about to happen, and I can already see it in the mempool, but it hasn't executed yet, you could bribe validators to get you in that update sequence in a way that you could possibly drain a lot of liquidity. We don't know how exactly. It's not worth our time to try to replicate or create that attack. But just to defend against it, we have a thing where if you want to update your DNFT or sync it urgently, you need to deposit DYAD urgently, do any operation on chain urgently, basically an operation that could be exploited. You have to cover the gas of every other DNFT. So that's really expensive if you need to do it like then and there. That's like thousands of updates. As nobody bids on that, the number of DNFTs you have to cover goes down. So it's a Dutch auction. So if nobody bids on updating all of them, the next one is like all of them minus 50, then minus 100, then minus whatever, until if nobody bids, nobody's urgent, you just can update yourself and do it then and there. But what this does is it puts a cost on executing anything urgently, so that like time-based attack is somewhat mitigated. And it also allows for most people doing normal non-attack type transactions on their DNFTs, you can do that for free without paying gas within like, depending on how aggressively people are building, like 1 minute to 15 minutes. The transaction will be executed for free because you will be included in one of those cohorts of people who are trying to use a time-based strategy to gain an edge in the system.
Interesting. Yeah, I guess my question could have been a lot more simple as, if you're running a bug type bounty to assess those attack vectors, but you got to the answer for the question that I guess I was really asking. Um, yeah, super interesting. Okay, so real quick with that. So if someone tries to run, so that kind of in a way eliminates someone trying to do a type of rapid attack, right? If they figure something out, but it's got to be a rapid attack in order to exploit it, right? That could Does that give you enough time with that strategy for people to catch that type of attack as well? Is that one of the
Yeah, and
thought
it's
processes there?
it's not no, it's not even about catching it because even if we caught it or could see it happening, there's nothing we could do to stop it. We
Oh,
don't
okay, that's
have
fair.
even as a team, we have no access to the protocol. There's no like emergency. It goes into a safe mode when certain conditions are met. Like we spend a lot of time on that, but it's all autonomous. Like there's no panic button we could press. So it's not so much about stopping it, it's about making it really expensive to execute. And that's
Okay.
the best we could do without basically gaming out every single possible attack, which would be a huge waste of time for the team.
Yeah, otherwise you would have to have governance and it wouldn't be able to be fully decentralized, I guess.
Totally, and
So,
it's unclear if governance is even able to solve this kind of thing. I think
yeah.
we've seen that it hasn't really. So yeah, I think that just putting pricing mechanisms in place for anything that could possibly be exploitable is like the design level approach we have to security risks that we don't know right now.
Yeah, I mean, that's a good approach. I mean, nobody wants to spend I mean, if there's that many NFTs, yeah, that would be extremely expensive.
Yeah, and I mean we run simulations like imagine a Wall Street hedge fund with basically infinite dry powder. They want to short DYAD and they have as much of a war chest as they need to make it depeg and crash. Like it's controversial if Terra was an attack, but however it started, it was definitely exploited by people with substantial dry powder. So what if something similar happened to Dyad? Well, the way that it's designed with the exogenous ETH collateral and the secondary market for DNFTs, there's no way to pull that off and be in profit. You would need to spend, in order for it to be worth shorting Dyad, the TVL would be at a level that would make it more expensive to pull that off by owning a majority of DNFTs than you could ever make by shorting it. So that again is an example of sort of solving an attack, not by actually solving it, but by just making it unprofitable in any situation.
Okay. Cool. Yeah, that makes sense. Um, all right. I guess I have one more question, and then actually, Life, I saw. Are you still in here, Life? If you are, raise your hand just so I can see. He might not be. He might be busy. Um, he asked a question, but the way he wrote it, I kind of wanted to have. Oh, there
Yeah.
he is. Yeah, I'm gonna bring you up here. So I see your question in the AMA questions. I want to make sure that you're able to ask it properly, and I don't butcher what you're trying to say here. Go ahead, man.
Life, are you there? I'm not hearing you right now.
He said 1 second. He's having a mic issue.
Oh yeah.
Um, while he's figuring that out, I'll ask my last question that I'm kind of interested in is there a percentage, right? So based off XP, right? I know that's you're able to mint more dyad, et cetera, et cetera. Is there a percentage scale for rewards, right? As you get higher in XP and the amount of money you're able to make that way, if that makes sense.
Yeah, so the way that it works, I'll sketch out real quick. So the protocol itself, before you think of any DNFTs, the protocol has the two vaults. It has the ETH collateral vault and it has the dyad damping vault. And then there's also the circulating dyad, which is dyad that's not in the damping vault that's circulating through DeFi as a stable coin. So the protocol is always looking at what is the ETHUSD price feed I'm getting from my Oracle, how many dyad tokens are currently in existence. So between the damping vault and circulating dyad, what is the total number of dyad tokens that just exist, period? And if that number is greater than the USD value of the ETH at that moment, the protocol will burn dyad from the damping vault to reduce that supply back down to be equal. And if it is less than the value of ETH in the collateral vault, then the protocol will mint new tokens to the damping vault. And those tokens that are burned from the damping vault when ETH is down, or minted to the damping vault when ETH goes up, those are allocated to the DNFT balance sheets based first on what percentage of that damping vault that DNFT owns. So that's where it just goes down to literally everything from the protocol is based on those three fields in each DNFT's balance sheet. There's how much DYAD they've minted and then how much DYAD they've deposited. So that deposit number, what percentage of the DYAD in that damping vault, the deposited DYAD, does this DNFT own? The new tokens are allocated pro rata based on that. And when the price of ETH goes down, the burn liability is allocated by the total number of tokens, DYAD tokens this DNFT is minted. So if you have half of your tokens deposited in the damping vault, but the other half are circulating, your burn liability is assessed based on all of the tokens that you've minted. So that's like stage one. Now, when you bring in XP modifies on a per DYAD basis what your mint or burn allocation is. So it shifts once there is that total number of tokens that are minted or burned. That's not changed by XP. What XP changes is how is that routed across these couple thousand DNFTs? What level of that burn liability per DYAD that you have deposited do you experience as a DNFT? Are you liable for? What amount of that new token allocation are you entitled to? XP and not the total amount of XP you have, but what is your percentage of all XP? What is your rank on the XP leaderboard? That's what determines, it acts as a secondary multiplier. That's what determines after the calculation based on a pro rata liability or allocation of your tokens. XP, your rank of XP modifies that per DYAD allocation or liability. So functionally, because the tokens are minted or burned based on the price movement of ETH, you have greater upside exposure and lower downside exposure to ETH the higher you are in that XP leaderboard, because that changes your mint and burn allocation. So what this eventually means, so this game can get pretty big without there being any external demand in the market for DYAD as a stable coin. Like DYAD could remain essentially a stable game token that this game pays out in for a long time. It could get pretty big that way. Once the market starts to demand DYAD, as I said, first probably as a USDC replacement, but really once it starts to discover how performative it is in terms of low carrying cost, because the market will only be buying DYAD from the very top DNFT positions, those positions that are essentially offloading their carrying cost onto all the lower positions in the form of burn liability. People are having trouble getting to the AMA. Hold on. The real like value of XP and of being on this leaderboard is basically being able to dump your carrying cost of supplying the market with DYAD on other positions and kind of cornering the supply of DYAD to the market once you get to the top. But yeah, that's basically how XP factors into this. XP is this hyperinflationary point system that, again, because it's not its own token, it doesn't have that same like farm token like constant sell pressure.
Okay. Can
Makes
you guys
sense.
hear me
All right.
now?
Yeah, go ahead.
You just
Okay.
Thanks for the
Cool.
explanation, by the way, Joey. That made a lot
For
of
sure.
sense. I think you
For
were
sure.
touching on a little bit of it early on, but we just got kind of too deep in the weeds, but that makes a lot of sense. Thank you.
Yeah, definitely.
So essentially, if you're using the supply to like absorb the price changes of ETH, positive and negative, could you essentially view the NFT as like a CD of the amount of ETH you deposited into the ecosystem to receive um, the dyad? And then basically, if they're getting returns based off that, or if they have a burn liability based off the amount um, placed in there, how is this more advantageous? Like I'm just viewing it as like it could potentially, yeah, it dampens the shock supply, the price change. But I mean, how do I really get rewarded if it's taking it away from the NFT metadata? And maybe I got busy part of the way through, so maybe I missed the answer to this during it, but it just
Yeah.
Go ahead.
No, I totally get your question. So thinking of the DNFTs, really like thinking of the on-chain balance sheets portion of the DNFTs as a certificate of deposit, that makes sense. It is basically a receipt for how much of the damping vault this DNFT owns and can withdraw. So that is an accurate way of seeing that. In terms of how you accrue value as a DNFT holder, so this gets into why the secondary market is so critical for the DNFTs. And it's so critical that we're actually building in marketplace functionality so you could trade DNFTs without any type of fee or royalty directly through our UI, and other other front ends will be able to tap into that functionality as well. But basically, regardless of if the secondary market is functioning correctly, and by functioning correctly, that simply means it will pay more for a position on the leaderboard than it takes to get to that position in burn DYAD, as long as that doesn't invert. And if that does invert, we have a safety mechanism that corrects it, basically by printing more XP at the bottom of the leaderboard. But that's fine because, again, it's as long as there's a delta between accrual efficiency on the bottom and the top, the absolute amount of XP doesn't actually matter. But you basically need a vibrant secondary market that will pay more per XP rank than it takes to get there. With that in place, regardless of where you are in the leaderboard, whether you're at the bottom and you're down in terms of DYAD because ETH is volatile, the price, it's kind of a crab market, all of your upside exposure is being taken by the top positions and you are sucking up their downside exposure, so you are down in terms of DYAD, the amount of XP you will be earning in that situation, you should be able to sell your position on the leaderboard for more than the DYAD that's being burned. And that
here's a macro condition I think I found
yeah, totally
of that. So in NFTs there is a lot of gaming, and I'm guilty of using this strategy because it's highly profitable. Is when I can control a certain percentage of the market yield and the listed amount is actually really low, I can synthetically make the market look like it's not in favor of your NFTs. For example, like right now, I'm on a Solana mint right now. They just released their second generation, so everybody is focused on their generation mint right now. So what I've done in this particular macro instance is, I control a good 40, 50 of those NFTs, and there's only about 400 out of a 5K supply listed right now. So I take a few of them and I synthetically dive the floor. So I'm basically creating panic in it. So that way other people then join the macro condition. They think that it's tanking. They're trying to get out and they list those NFTs under value. So I buy up the other ones and quickly delist the other ones that I have. Yes, I could lose a few of my NFTs, but the strategy tends to be that I gain double what I lose because it creates that panic condition. So that macro would cause you to synthetically overprint XP, therefore allowing somebody to actually double up on that position because your safety mechanic has not only given them more NFTs because others joined the macro condition, but the macro condition triggered your safety position.
Yeah, no, that's a really good one. Yeah, I think that the difference here is you can only really do that when the price finding is so inefficient and is really not based on any fundamentals. And this is why I think NFT traders are a different category than like DeFi or just token traders. I think that I know people who are great at both, and there tend to not be a lot of overlap between those two. Mispricing of NFTs is so prevalent because there is, in most cases, no actual like utility that you can use to do any sort of fundamental calculation on them. In the case of DYAD, a DNFT's value will ultimately be tied to ETH's implied volatility. So if basically when you're buying a DNFT on secondary, you're making a bet on the market through the pricing of these DNFTs and ultimately what is the difference between a certain rank on the leaderboard and floor. That's how the market is pricing ETH's implied volatility. If I think it's going to be greater,
you'll always have the macro of somebody just wanting to exit and get liquidity at that point in time. Because here's the difference between token traders and NFT traders is a token trader can basically exit anything anytime they want. So long as there's a liquidity pool for them to exit, yeah, they may take some price impact, they may take a loss, but they can recuperate some of that. They can set stop losses. An NFT market requires a peer-to-peer transaction. So you need a buyer in order for you to get your liquidity back out. So this is how you could exploit that macro. Like
True. I
flat out.
mean, this is why NFT AMMs are so important. Like the marketplace that we'd be building internally would absolutely use an AMM. Probably not one that we design completely ourselves, but whatever that trading, that internal trading functionality is, we would be acting, or the protocol would be acting as a market maker. And that's not possible with a lot of DNFTs, certainly not with like generalized marketplaces. I think like, SudoSwap is doing some super interesting stuff there. And there's some others that are newer that are kind of building on that NFT AMM thing. And I think there's more financialization that has to happen of NFTs in order to make that like truly, truly viable. But I agree with you. If you don't have an AMM and there's no market maker and it's completely peer-to-peer, you can game it in these ways. Again, I think the difference is executing that strategy on DNFTs and DYAD and trying to basically drop the floor by doing these super low ball listings and create a sense of panic. That mispricing, you could immediately profit off of it. I think the difference is mispricing on other NFT series. Your only profit potential is someone buying it for more and the price appreciating. There's no utility that is not like getting into a party. It's like getting more ETH ultimately that most of these collections have. The fact that you could, through a mispricing, immediately profit off of that, I think will make this a harder strategy to execute, or at least less profitable. But
I mean,
you're
so I'll give you
absolutely
an
right. This is
example of
viable
these
for
of
NFTs.
these NFTs that I have. Some of them have yields in actual coins that have liquidity pools that I can pay out. So, I mean, it's a kind of it's the most similar that I could view. And even if you have your own marketplace with an automated market maker, the thing with NFTs is they can be available through many different marketplaces. You can't really control where somebody lists your NFT if they have control of it. So they could take it to a completely different marketplace for the chain, and they could list it that doesn't have control of that, and spread some rumors. I mean, we all know how the Twitter rumor mill works. We all know how the FUD machine works. It's just like, oh my God, do you see this? There's like 10 listed on this. It must be dying, and create the macro condition. It is literally an art that is gets used a lot,
No,
and
I absolutely hear you. I've seen this used before, and there's definitely no. It's not controversial that this works and this has been executed successfully. I think
yeah.
that with the difference between like a Solana, and yeah, Solana's kind of been like pushing the boundaries on like staking of NFTs and things like this. The conditions, so the upside potential with holding a DNFT, especially if you were able to buy it for a mispriced amount on the low end, um, you can, without trading it back on secondary, you could immediately be in profit from that position. And I
No,
think
I don't
that
disagree with that
it's
either.
not like it kind of changes the level of speculation we're talking about. So for the call it highly profitable trade you're discussing to execute successfully, there needs to be all of the value inherent here, or the majority of the value needs to be based on speculation, because that's what's needed to create the level of fear that will cause a true crash and floor. I think that, again, this is probably the most viable uh, potential threat that I've heard so far. So I'm really digging into it. I'm really thinking about it. I think that it's just there's too many ways to accurately and objectively price a DNFT by running something similar to like Black Scholes, or right now the quant team is literally working on a dyad version of Black Scholes to interact with some of our larger investors who want to forecast with this and want to price it. There's no way to do objective pricing like that on kind of your standard art or PFP based NFT series.
I mean, I could tell you exactly how I would do it with your with the with DYAD is I would wait for an ETH macro condition. So, maybe some bad news comes out about ETH, or somebody brings something up about the transition, because they did just transition from proof of work, and creates that macro condition in which then I can basically follow right along with that macro condition, underlist 4 or 5 NFTs, and watch them come out, because like you're saying, it's not just the NFTs that go around this. It is the whole machine. It's the whole thought process behind it. So since you are going with something that does go up and down, you're literally building a shock absorber for ETH, as you said. So all you have to do is wait till the shock is bottomed out. It's in the worst possible condition at that moment. Slam the macro play in there, watch the panic ensue, and basically set your stop losses at the same. Okay, I lost.
No. I totally see what you're saying. I mean, the way that it works though, so anti-reflexivity was a major part of our design goal and sort of underlies a lot of the system. The closer you are to basically the peg falling, which is, we have a protocol-wide collateralization minimum ratio of 150%. That's not per DNFT. Individual DNFTs can go way more aggressive than that. It's just a protocol-wide. And falling back to that, honestly, given the incentives around withdrawing DYAD, is going to be like a super edge case. It's just there for safety. But if the protocol is approaching that, which if ETH is bottoming out and people are getting really nervous, maybe nervousness about ETH is, I mean, we're absolutely exposed to like feelings about ETH. We're basically a play on ETH. But we're a play on ETH volatility. And that's really the fundamental thing here that is different from just going like levered long on ETH, for example. You profit as a DNFT holder, and the protocol ultimately is strengthened because incentive to put liquidity against the peg and to bid on DNFTs is directly correlated to ETH volatility and ultimately how the market is pricing ETH implied volatility. So if we're heading into one of these inflection points or macro events, generally vol spikes around those situations as well. So there is going to be certainly a level of fear and liquidity outflow from anything and speculation. But if you're holding a DNFT, that could be your most profitable time if you believe that volatility is going up. You don't have to have a position on ETH's price direction. That will actually play less of a role in how much XP you can earn on the lower end or how much DYAD you can earn on the upper end than how volatile ETH is. So you are betting on ETH volatility. I don't think that, I think if anything, volatility spikes around these events. So it would be, again, if your strategy was to time your sort of, let's just call it phantom mispricing, basically, to cause panic around that moment, there will be people, and these people are attracted to DYAD because of the kind of protocol it is and the level of like strategy possible, level of upside if you're good at it. They will be waiting for a moment like that. They'll be waiting to buy at a point where they could maximally profit by holding a DNFT through a certain period.
Yeah, but to be fair, that's a speculative statement in that fact of saying, you're saying you're building something that's supposed to protect against this speculation because it's the shock absorber. But your defense in this scenario is that there's going to be people waiting on the outside to speculate to buy the dip, sort of deal, which
speculating on DNFTs is great. I mean, that's what they're designed for. The DNFT trading side, that's what the name DYAD means. So DYAD refers to two parts of one thing. Those parts are generally opposed in some way. And the more opposed they are, the greater contrast there is between the two of them, the lower the entropy and the higher the potential energy of the system. So DYAD, the coin, the token DYAD, will always be completely devoid of volatility. If there's any potential to speculate on DYAD, the ERC20, then something is very broken. that should be rock solid, stable, zero volatility, unless the protocol is breaking. So there's no normal expectation of drift off of peg. It is a hard peg. There's no reason to speculate on that.
Well, I get
All of
that
that
you're over collateralizing it. Yes. No,
yeah, all of
I
the
get that.
speculative energies directed towards the DNFTs, which yeah, that is absolutely a speculative investment, but you're speculating on ETH's volatility. You're not speculating on ETH's price. And that changes the psychology of fear and greed going into these potentially exploitable macro events. But yeah, I will absolutely grant that this strategy of causing a sense that people are selling out of DNFTs for whatever reason, and maybe you start something where there's like some unfixable problem in the code and everyone's going to lose everything. Yeah, you could do that. I think that if we don't have a group of people ready to buy into those mispricings because of how the protocol works and how they understand the upside, we will have messed up in some way of communicating or launching or getting to the right people. But if those people aren't there and you just have like people who, it's not even about holding or paper hands or diamond hands. That's not what this is about. It's about people who can see the profit potential, like the immediate profit potential. Then yeah, then you could cause sort of FUD around the price, and the pricing of the DNFTs would go down. It would recover.
Well, here's
really
the thing too: is how does the XRP thing happen? Because you're saying if you have basically one of them get listed too low, you're going to get the bonus XP. I'll just call it XP, and that's going to help change the macro condition within your protocol with the DNFTs. So I mean, even if I flash a few of them in the market, I flash enough to affect the overall general price of it. Are you going off average sale? Are you going off of some average sale versus volume? I mean, it really depends on how you're setting that up, because if somebody can flash the floor and they've got enough, like they will, I guarantee it. Somebody will sit down and they will do the math. They will flash the floor to get the XP to gain the position that they need to in the protocol. It's simple, in the end, it's oversimplification, but
right.
that's, I mean,
So we
that's
could.
what
So
people do.
what is? So how does this attack play out? So if you could, let's say that you're able to pull this off. You're able to, as you said, flash the floor, and you could buy more DNFTs at a much lower price and get into positions on the leaderboard that have then greatly mispriced those positions. Now you're there, and you got in there at a bargain. How does that? How does that how does that compromise the protocol? Like, yeah, that's kind of an aggressive trade that you pulled off and you use some social engineering. The protocol should welcome that. And like, this is why I keep talking about this Avi guy. Like, anything you can do with the code, the protocol should be able to, like, the more aggressive that is, or the more it's trying to break it, with this design, it should, if anything, just benefit from that.
Well,
At worst, it should be neutral.
so the attack is based on the XP system itself. So even if I'm not able to pick them up, like I flash it, nobody's biting, and I cause the XP system to basically rebounce, because that's what you said happens if you have a macro event in which the DNFTs are losing value, like um, the bottom.
Oh,
The
sorry.
bottom one.
So okay, I think that's where the misunderstanding is. So the way that we determine that, it's not by looking at like the OpenSea API and like getting a floor price feed. It's, we only look at sales basically that we can see on chain and see how much were they sold for. We basically do volume bucketed average price. So we don't look at time bucketing, we just do volume bucketed.
Yeah, so
And we look at average price. So
yeah,
if
so
they
no,
don't
the attack would
sell,
remain valid. Well, yeah, if they don't sell, it wouldn't pull off. But
right.
so say if I place the floor bet, so sort of deal,
Mhm.
like I'm making
Mhm.
a bet, saying, hey, I got the social engineering in place. ETH is having a crazy macro as is. I can make a few people sweat. Place my bet. A few other people dive in and maybe try to undercut me to get out first, and I snatch a few of them up. Now it's added to the sales. It's drugged the average sale price down versus the total volume, and then I
Right.
scoop mine back off the market. I've effectively messed with the XP equation of that, and I got a bigger lion's share of the
Yeah.
protocol, the DNFTs.
So I think the biggest thing there. So let me describe what happens when the XP, let's just call it the efficiency curve, gets thrown off like that from like a bump in uh like XP secondary market pricing, basically, or like leaderboard position secondary market pricing. Say that experiences this flash crash, basically. What happens then? What happens with the XP curve? The top of the curve, so the part of the curve that touches the very top positions on the leaderboard, stays at essentially 0 XP per dyad burn. So it stays at like 0.001 or whatever it is. The dynamic side is the lowest end of the curve. So that's where that's the lever that the protocol ultimately has to affect the secondary market pricing. So if we basically see that DNFTs have been traded and they have sold in a volume bucketed average price that is less than it would take to in dyad burn to get to that position, then we increase the lower point on that XP accrual curve from like 1 XP per dyad burn to, I don't know, 4 XP per dyad burn. But it's still a logarithmic curve that approaches 0 towards the top. So we respond to secondary market mispricing or underpricing in the case of this by increasing the delta in XP accrual efficiency from the bottom of the leaderboard to the top, essentially. And it's still on the same type of logarithmic curve that falls off as you go up the leaderboard. So, yeah, what we've basically done is made it less expensive to move up the leaderboard at the bottom regions. What that does is it just stimulates the type of flipping that really accelerates movement throughout the entire leaderboard, but starting it at the bottom by creating this spike in XP accrual efficiency that is sort of in line with the drop in secondary market pricing that we've just seen. That just makes it more incentivized to invest at the bottom. And that's really where the protocol needs liquidity at that point, and it rewards those who jump in at that point because they accrue XP and can move up the leaderboard relatively cheaply. And then as the secondary market recovers,
let me
it
continue
goes
the back half of
Yeah.
because of that. Now it's pushed. So maybe I have a couple that are higher XP rated, and I'm trying to push up the ladder. So I've got more to offload and to affect the ecosystem as a whole, right?
Mhm.
So I take some of the ones that I hold that have a lower XP, and I do this flash. We'll call it a flash attack
Yeah.
on the NFT side of it. So
Yeah.
then I've synthetically pushed my other NFT up the leaderboard, giving me more power to offload on the rest of the ecosystem.
Mm-hmm. Synthetically pushed your other DNFT up the leaderboard.
Yeah,
So,
because I flashed it.
mm,
Maybe somebody else paper handed with me,
mm-hmm, mm-hmm.
or I failed the bet and somebody bought a couple at a really cheap price.
Sure.
I still got a boost in my XP for my higher positioned NFT,
Correct.
because NFTs can all have their unique position. That's the
Yeah.
premise on this.
Exactly. That's the whole way
So
that it
then
works.
now I could gain basically a leverage on that I have a better position to offload within the ecosystem.
Yeah, that's absolutely correct. You would have gotten into a top position on the leaderboard for cheaper than it should have cost you.
Exactly.
That's absolutely correct. But
So
the
if
whole
this were to continue,
yeah,
so say I successfully pulled this off. I create a dump on the ecosystem. Now not only have I started the FUD, have I started the macro condition. A couple came and on-bounced the XP system, so I gained a better leverage point. Then I dumped on top of it, and then people are like, "Oh yeah, crap! It really is crashing." They begin to list more. It goes further. I gain more, I gain more XP position because the boost is given back to me yet again because the floor dropped. I gain more leverage. I dump it back down. You see how the cycle could just continue. It's kind of
totally.
like a cascade.
But you will get to a point very quickly there where your greatest incentive is if you have the higher you go up the leaderboard, the greater your alignment with the protocol. So the more you stand to profit if you start to sort of, it's weird how incentives work in this case, but basically the protocol's health starts to be more aligned with your P&L the higher up you get to the leaderboard. So to continue, so once you're in that top position, you may have done some highly profitable trades to get there, which is fine. The protocol's okay with that. You got in. Once you're up there, to continue to mess with the floor or to try to break it,
It takes
you
more
will
because you get closer to the net zero. Yes,
exactly. So you start to just harm yourself. Now, fine, that's an okay defense. It's not a hardcore defense. Like, let's say you're a psychopath and you just hate DYAD and you don't care how much money you spend trying to break it. Then
There's
yeah,
people like that.
you could probably do that, but the amount that it would take to do it, it would require somebody to just like have a vendetta against us. There'd be no upside. And the fact that there's no upside and it would be expensive means that after a certain TVL, nobody will do this. The only reason you get people attacking protocols is they can make a lot of money.
So no, I disagree. So I push the initial NFT that I had in a prime position to gain a top leaderboard up until basically I get close to zero or it's not having a great enough effect to keep me profitable. Then I list that top NFT down back at the floor and then ride the next NFT up on the cycle. Then once that one's at the top, I dump that one, pick up another NFT, ride that one to the top.
Wait, by dumping, if you get to the top and you sell for less than it's worth, you're leaving more money on the table than you could possibly make by running that loop. There's just the way that the allocations work and the curves work out, that position you will be leaving more money on the table by exiting that for less than the market would pay, than you could possibly make running this loop. And ultimately, that's it. That the defense is that you'll lose money executing these attacks. If you just hated the protocol and wanted to erase it, you won't be able to erase it exactly, but you could screw with people's positions for sure. It would just be super expensive to do that. And the more you want to mess with people's positions,
I
the
would
more
be
expensive
interested
it
to
would
see
be.
the math on that because I've made enough of these plays in NFT and NFT slash token protocols that it's been highly profitable to, maybe not necessarily, and I'm not saying it necessarily will crash it out completely, but causing a macro condition that basically allows me to swing trade it. So, I use a couple and push those up and then maybe offload a couple so that way the XP is giving me enough to dump down, right? And then I have the other money to double into the position.
Yeah, it's possible that there is a specific macro condition where you could be up by owning a top DNFT and listing it for way less than the market would price it and running that loop that you described. I can't think of it right now, but that doesn't mean it doesn't exist. I think that you've uncovered something that could be exploitable. So what I would like to do, how technical do you like to get with this stuff? Like, do you construct models to sort of understand this stuff in a more substantial way? And like, is that how you've run your NFT oriented strategies previously, or is it more just like spending a lot of time researching and understanding mispricings of fundamentals?
It's time and research and then running the math against it. So basically, I hop on and see basically how much it would cost me to begin the loop, and then the macro condition what it'd cause, obviously, because the tokenomics you can basically do the math on.
Right.
So say I cause I run the loop, it costs me $5,000 to start the loop, but it creates a 20% dip in there, which I could buy. I have maybe 10-15,000 in capital to buy after starting a loop because I've got a total investment of 20,000 to make this play with, and then I do the math on whether the protocol bringing it back to a normal stable condition after me causing this macro flash, we'll call it, would have more upside in that than me continuing to play it. And we see this in a lot of different protocols, not just NFTs and not just things like this. And, you know, people do this on basic, and I know people are going to cringe, but people do this in basic tomb forks to where they could be more profitable if they played it in a different fashion, but they do the math and they find that, hey, it's about just as much, or I can make it faster by, you know, dumping the peg, creating a flash macro condition. A bunch of other people panic, they get out, that gives me another 10%. I get in, I look like the good guy because I restored the peg. I gobble up, you know, a couple, two, three prints on it until I unlock in the boardroom, sort of deal. So now I've got a bigger amount of tokens that I'm carrying, sort of deal, and then I dump it down on the ecosystem. So, you know, I play a lot of Tomb Forks as a short-term degen player. Sometimes I play a lot of NFTs when the market conditions do that. So, um, and a lot of the newer NFT ecosystems, because of the bearish market conditions, have had, you know, they stake for a token, and that creates a value proposition and ecosystem, much the same as this potentially, you know, does. Is, you know, there's a couple to where you can sell the token flat out and get, you know, money back from it. So, you know, I would really just need to know the math on how the percentages and the rate in which it falls off. And really, honestly, anybody probably involved with your team could do that quite easily. Is figure out how much you would have to affect the floor price of the NFT to cause enough of a slide to where the dip would be worth it. Um, if the XP is overweighted down at the bottom, it's going to create a more profitable slide, because I get that you're wanting it to do that because you want the people then to hurry up and fight for the floor. You know, you want them to rebuy it to restabilize the price. But if you leverage over too far on that end of the scale, it's gonna reward people that potentially could play a loop scenario like this.
Totally, because you're basically playing that delta between the
Yep,
top and the bottom,
exactly,
and we're
exactly.
increasing the delta. Yeah, no, that is smart. That is, I've heard like 20 of these at this point. This is definitely the most thoughtful one. Um, Here, I'm gonna post in the chat right here.
Or if it's something that you just want generalized, you can DM me too. My DMs are open.
Okay, cool. I'm DMing you a link right now to our Sims, and if you're at all familiar with Python, you should be able to be flying on this in a second. I'm also happy to put you in touch with somebody from our quant team to walk you through if that's useful. But I really want to get your deep dive on this, and I would gladly reward you with a DNFT if this would actually break the protocol. So yeah, if you don't mind checking this out, and then I'll put you in touch on Discord with one of the members of the quant team so they can walk you through it, and then you could really understand, we want to understand, would this type of attack, could it actually be profitable to execute against DYAD?
Yeah, because
And then
I
even
mean,
if
if
it
it's
is profitable,
profitable, you just
could it
continue.
break, yeah, could it break the entire protocol?
Well, I
So
mean,
let
that's kind of
me
a self-answering question. As soon as it's profitable and it can be exploited, I mean, it's just a matter of recreating the exploit in a circle. And
Sure. That
yeah,
then that but then it becomes a question of how
do you
special
harm
is the
yourself
macro
enough?
condition?
Yeah,
Do you harm yourself enough? How scalable is it? Like every exploit has like an addressable market basically.
yeah,
Um like how hard is it? But really like what is the window and the probability that another one of those windows will appear? I mean I can tell that we'll enjoy talking with you. We talk about this stuff all the time. Like what is the how do you model the statistical probability of certain like things, and how do you tie that into making it too expensive given the probability and the addressable market of the exploit? Yeah, so this is good. It sounds like you have some stuff we could feed into our risk modeling. um okay, just accept my friend request. Cool. I'll DM you here, and then I'll invite you to our quant channel on the server. You should have just gotten a Google collab
cool.
link that you can check out, and yeah, our model is basically living there right now.
Yeah,
You should
I'm
be
a
able
little
to.
rough on Python, but I should be able to work my way around it.
Awesome. And like I said, I'm happy to put you in touch with somebody from the team who's actually building it.
Yeah, if I beat my head
To
against the wall too hard, I'll do that.
perfect. All right. But look, I very much appreciate you coming up to the stage and giving this very thoughtful attack scenario. Definitely worth our further discussion and investigation. And you're definitely at the top. If you want to know leaderboards, you're at the top of the leaderboard of winning that free DNFT right now, because I don't have a clear way of saying no, this is not a possible attack, which is great. That means that it's good that you're bringing it to us. So cool. I just sent you the link. I'll invite you to the Discord, put you in touch with the quant team. But yeah, I really appreciate it. That's very thoughtful.
Yeah, not a problem.
That was impressive. I'm gonna need you to live offline. I'm gonna need you to break that down for me a little bit later on.
Yeah, not a problem, man.
I that's just like, yeah, a lot of experience. I'm excited to learn.
Yeah, no,
a bit more
it's
about that.
very smart. I mean, recognizing that the greater the delta between XP accrual at the bottom and the top gets, the more incentivized it is to run a loop. That is a possible reflexive mechanism that we have not dealt with yet. So that's ultimately what I'm focusing on. Is there a potential for reflexivity as the delta between XP accrual increases in a gradient across the DNFT leaderboard?
Yeah, it's a
First
classic
iteration.
degen short play. Basically, is
Yeah.
you're basically causing a short loop to where you're giving yourself the overall advantage of the price action.
Right, exactly. Yeah, we need, and mostly the fixes there is like degen detectors of some kind. Like, can you detect this happening? Can you change if you do that? I'm very bearish on like any kind of like trying to use on-chain data to detect an attack. I think that you can't do that accurately. So, or else that's very easy to defeat. So it's
Oh yeah.
really like, can you make it more expensive than it's worth? That's really the only defense against something like this. And that's the question that we're going to be looking to answer. So yeah, Life, thank you very much for that. Like I said, we'll get you into our Discord, our team channel, and we'll discuss from there.
Sounds good. I've got to run for a bit though. It sounds like you guys were gonna end up closing things out here shortly, anyways. But
Yeah, this is probably going to happen like tomorrow. This is my
Yeah.
last call of the day, and I'm just doing building stuff after this.
Yeah, I gotta eat because
Yeah.
I've got a little YouTube meeting at 9 that I've got to be
Nice.
available for. So yeah, no, I never stop. I'm like part of 5 protocols right now. So yeah.
Awesome. Well, I'm really happy that you showed up and that you presented that. I think that bringing this discussion to the team is just going to, yeah, move us in a direction that we absolutely need to be thinking about.
It's a
And
fix
yeah,
that could be placed. I mean, it's a matter of getting the balance correct. But in the current situation, it all depends on the math and what you have in there.
totally. And I completely get why you wanted to actually see how the math plays out, because it's just, can you find a window that's exploitable?
Yep,
Yeah,
delta window. That's it.
that's a really good really good attack theory. Okay, cool. Relentless, thank you for for putting this guy in touch with me. This could be super valuable.
Oh yeah, 100%. I actually
literally
got
literally have not had a proposal nearly that strong yet. So really happy
I
about that.
I got linked up with him in the exact way that you just got linked up with him. I was hosting an AMA for a GameFi protocol in a separate server, and he came up and started asking a bunch of questions, and I was like, I need to get in contact with this
Yeah,
guy.
I love it.
And then, yeah, and then you just never know just what people know, so it's crazy. But yeah, absolutely. And thanks so much for your time. I don't want to take any more of it. I think my wife might kill me if I try to. Anyways, but and how am I gonna follow that up anyways? So yeah.
Totally.
So with
Yeah, well,
that,
this was. Oh no, go ahead, man. Go ahead. You're about to close things out.
oh no, go ahead.
Yeah,
If
I
you
was
got
just
any
gonna
last
say that
statements, I'll give
I
them.
really enjoyed this. We went like super over time, but I like the style of AMA that you run, and yeah, I'm more excited than ever to like really make this bounty as public as possible to get like more dudes like Life to bring proposals to us. So yeah, I this is super useful. Thank you again for having me. You never know how these things are going to go. Like someone like our lead investor, yeah, like you said, I met on like a Twitter space. So it's
Yeah.
it's a funny world that we're in that just rewards, I think, getting as deep into it as possible while maintaining some level of mental health. That's important too.
Yeah, absolutely. Mental health is extremely important. And trying not to get too much screen time, and at least get the right amount of screen time. So, but hey, I appreciate the compliment as well. That really means a lot to me for someone who is. I've only been in crypto altogether for about a year, DeFi for about 10 months, and in this scene, hosting AMAs for about 3 months now. So I really appreciate that. It means a lot.
Sure,
So,
man.
yeah, so with that, I'll go ahead and wrap this up and let everybody go. So thanks, everyone. I mean, this has been, this is a typical bullet point would just be a great AMA, but this was a phenomenal AMA. This is so far absolutely my favorite AMA and the most that I've learned from anything, and just the follow up there with life was just phenomenal. So thanks so much to you, Joey, for being here with us and taking the time to spend with us, and life for coming up and and giving them something to think about, and just being such a great addition to the show. So we're looking forward to seeing what's next from DYAD and watching this progress as it goes, and I'll be keeping in touch and keeping track of the project. So
Excellent.
thanks again,
Excellent.
everyone. Yeah.
All right. Well,
Yeah.
thank you very
so
much, Relentless. Thank you, Life. Thank you, everybody in the audience who joined. Pandam, soon to join.